hold on to your wallets. Gold just got absolutely wrecked. It was the biggest smashdown in years, erasing weeks of incredible gains in a single day. You need to know exactly why this happened and whether this metal is toast or about to bounce back and hit 5 grand. Just days ago, gold was soaring, hitting a massive all-time high of about $4,380 an ounce. It was untouchable. It had gained more than 50% this year alone. Then, the bottom fell out. In one brutal session, gold futures sank 5%. That is the sharpest single-day decline we have seen since way back in 2013. It wasn't just gold either. Silver plunged hard, dropping about 7%. Platinum got hammered too, falling over 7%. This wasn't a slow leak. This was an explosion. The price action was simple panic selling, leaving gold trading around $4,100 after the dust settled. So, what the heck caused this sudden collapse? It comes down to 3 huge reasons. First, pure profit taking. Guys were printing money on this rally. Gold had been soaring straight up for 9 weeks straight, hitting record after record. When an asset runs that hot, traders call it overbought. Eventually, everyone realizes they should cash in their chips. When massive institutional money decides to sell, the floodgates open and the price drops like a rock. Second, the U.S. dollar woke up. The dollar index, which measures the strength of the dollar against other global currencies, jumped by over 0.5%. That might not sound like much, but when the dollar gets stronger, it makes gold instantly more expensive for every single person outside of America trying to buy it. When the dollar flexes, gold usually drops. It's a classic move and it crushed the rally. But the biggest reason? Peace rumors. For months, gold has been the ultimate panic button asset. You buy gold when the world looks like it's falling apart. And lately, it looked like it was falling apart everywhere. But then words started leaking out that the trade war between the U.S. and China might actually be chilling out. President Trump came out sounding friendly, saying he expects a strong trade deal when he meets China's President Xi next week. A potential trade deal kills the urgency. Trade tensions drop, the global economy looks a little less terrifying, and traders suddenly stop needing that safe haven metal. They go running back to stocks and other risky assets. A cooling trade war plus a stronger dollar equals disaster for gold. Now, you have to remember why gold was screaming higher in the first place, because those problems haven't magically disappeared. This rally wasn't just about fear, it was about broken trust. Hedge fund billionaires have warned that gold's insane rise is a giant alarm bell flashing against the US dollar. They say it signals massive anxiety about the dollar's long-term strength. The fact is, central banks around the world have been quietly buying up gold at a feverish pace. They aren't switching to the euro or some other currency. They're switching from paper money into physical gold. It's a huge shift. This all happens while our political landscape is a total mess. We're dealing with an ongoing U.S. government shutdown. Lawmakers have failed multiple times to reopen the government. This chaos creates huge economic uncertainty. Worse yet, the shutdown has cut off traders from vital weekly reports that show how hedge funds are positioned in gold and silver futures. When you fly blind like that, volatility skyrockets, making the market unstable. We also had massive banking jitters recently. Remember those reports of loan fraud at regional banks? Reports came out alleging huge fraud cases at California Bank and Trust and Western Alliance. In one case, a borrower allegedly drained an account that was supposed to hold a $2 million monthly balance down to barely $1,000. That kind of revelation sends a panic signal through the financial system, reminding everyone of the 2023 regional banking crisis. What do investors do when they fear banks are shaky? They buy gold. Then you have the Federal Reserve. The market has been betting big on lower interest rates. Investors are banking on the Fed cutting borrowing costs twice more this year, likely with 2 quarter-point cuts. Lower interest rates are rocket fuel for gold. Since gold doesn't pay you anything to hold it, when regular savings accounts or government bonds pay less, gold looks much better. Those rate cut expectations helped push gold prices up more than 50%. But let's not forget the trade war itself. It moved from a quiet time to open confrontation recently. Back in September 2015, the U.S. slapped tariffs on things like timber, furniture, and tools used for making semiconductors. China punched back immediately, restricting exports of 5 rare minerals. Washington fired back with a 100% tariff on basically everything China exports. This escalation immediately disrupted shipping and logistics. More port fees between the U.S. and China mean higher costs and slower freight flows. That harms global economic output. And get this demand risk hits right as the International Energy Agency is warning of a massive oil supply surplus of up to 4 million barrels every day in 2026. Weak demand, combined with easing tensions in the Middle East, is making the outlook for crude oil look extremely grim. Speaking of oil, some analysts think crude prices are due for a pretty big drop. If you look at the charts, crude oil futures have the potential to fall all the way back to about $42.50. That potential gain is roughly triple the potential maximum loss if you were to jump into a short trade now. This entire global mess is a massive signal that the U.S. can no longer rely on China. Brazil, believe it or not, is a big winner here. Brazil's exports are booming as other nations try to diversify away from the U.S. A trade idea to bet on the Brazilian currency, the real, suggests a potential gain that is about 4 times bigger than the calculated maximum loss on the trade. But back to the precious metals meltdown. This drop has caused genuine pain. In places like New York's famous Diamond District, small-time investors who bought at the peak are reeling. People pouring their retirement savings into gold are now facing huge losses on paper. Is this the end of the rally? Some smart guys say absolutely not. They point to the ongoing uncertainty, central bank buying, and geopolitical risks, and argue that this is just a necessary pullback. Some major banks are even calling for gold to hit $5,000 an ounce by early 2026. That is huge. However, other economists are screaming the opposite. They warn that gold's value has surged so far past its fair price that it is now completely in bubble territory. This massive volatility is going to keep rocking the boat. The government shutdown has left us waiting for crucial economic data, specifically the U.S. consumer inflation report, which is expected to show prices rose about 0.4% in the last month. That number drops this Friday. If the number is softer than expected, it means the Fed is almost certain to cut rates, and that would immediately send gold flying back up. If inflation is hot, the Fed might hold off, and gold could plummet even further. So, here's the bottom line. Gold just saw a monster correction that was long overdue, but the fundamental forces that drove it to record highs, economic fear, dollar instability, and central bank demand are still hanging around like a bad smell. Expect things to stay bumpy, but keep your eyes glued to that inflation report this Friday. Do me a favor. If you like having this kind of no-nonsense, straight-talk information delivered to you fast, hit that like button, make sure you subscribe so you don't miss our updates on the market insanity, and ring the bell so you get the alerts when we drop the next video. I'll catch you on the next one.